where, a lot of times you get a breakout, and it's like, oh, and it takes a while for that to catch on. So it's possible that once we, start exceeding some of those levels, things could move pretty quickly. And there's a number of macro issues that might drive that, Andy. That's for sure.
Yeah, and I saw that report. It's always well received, and I think you did that via the Sprott channel, and really good, really excellent. I mean, so I mean, it's hard to distill stuff down, but essentially, we started this year a little more bullishly than I actually really anticipated, but some structural stuff going on here. Craig, what are you seeing, my friend?
Yeah, we came out of the last week of the year, last 2021, and drifting higher and like, hey, okay, maybe we got a little momentum. And man, they just put it to us. Remember on the first trading day of the year here in the U.S., then on the third day, it's like, oh, man. But it's been pretty good ever since. And excuse me, as we record this, there's a cute little channel on the daily chart that gold keeps following higher without getting overbought. And that's where a bull trend should look. And one nice thing, Andy, is, and you know this, while it's painful and frustrating to kind of flag out like this on a chart and consolidate gains after a big run, because everybody wants to just to keep going. But that's never, it seems, how it works. But the longer you channel, you kind of consolidate like this and flag out, the more it becomes clear to everybody what the levels are that when you break out, and so everybody right now is looking at 1880 and then beyond there, 1920. And as gold takes out those levels this year, there's not a whole lot of people that follow gold or follow the markets in general that won't notice, where, a lot of times you get a breakout, and it's like, oh, and it takes a while for that to catch on. So it's possible that once we, start exceeding some of those levels, things could move pretty quickly. And there's a number of macro issues that might drive that, Andy. That's for sure.
Yeah, and I think one of the good things, one thing I love about you Craig, you don't just have a view of what's going on in the paper markets. You also see the other side of the picture, and I guess we tend to live in this COMEX central world, and everyone looks at the COMEX, and obviously it's a major factor. And I think it is, personally, I think that is where the BIS operates, definitely central banks operate. We have, of course, GATA, Chris Powell talks about it all the time, and he's right. It's because it's a paper market, and in my view, because it's a paper market, and because you can basically, there's enough suckers in this paper market to take an undeliverable contract, borrow it off the big guys, and play a game, which they're going to lose. As in any casino, 95% goes to the house and 5% goes to the players. So, but I think the central banks can't really operate so fully in the over-the-counter markets because it's deliverable. And I think one of the key things I'm taking away right now, especially after the 280 tons of SLV that supposedly went into the SLV yesterday into a declining silver price, but you can see that basically the flywheel is all paper. And so you can settle out the paper market. The minute you start to go into the over-the-counter markets, which is physically deliverable, then really you're starting to get on very, very dicey turf. So, and then I noticed that the one flywheel that's left is the ETFs. With this, the ability to not, and what was it? I mean, we just did something on this a minute ago. What BlackRock said. We may be unable to acquire enough of the metal and the SLV may suspend or restrict the issuance of baskets of shares. Hello? Hang on a minute. 280 tons of silver was bought yesterday, Monday, and the price went down? Hold on. I can't buy that silver. No one I know can buy that silver. If we went at market and bought silver, it'd be $30. It'd be at least $30. Right. So to me, it's an interesting that. Thank you for having that bigger view.
Well, Andy, I got to pat you on the back. I mean, getting to know you over the last decade, I mean, you were the one that first taught me about the shenanigans in London, and the spot index orders and the unallocated book and how they just take metal and move it across a line in the vault with a forklift and all this. So anyway, the thing is, so many people look at gold and they think of it as just as you say, a dot on a screen. It's just a price that crawls on the bottom of the page on CNBC. But there's so much more that goes into it. And if you're going to follow gold as I do, like I tell the people on my site, what they pay me for is be their eyes and ears. I'll sit here and watch this stuff all day long and, write about it in the morning and record a podcast in the afternoon so that you don't have to. And if there's something big going on, I'll let you know. But my job is to keep track of all this for you. And if you're going to track gold, there's a lot you got to keep track of. It's not just, whatever the demand numbers are out of, this or, there's all kinds of different fundamental reasons that people get, that they think are important when it's a whole basket of things. And that's what I try to write about. That's why I call it a macro cast when I write these annual reports. And I'll give you two quick things, Andy, that are already in the news here in January that are driving gold higher. One, again, we're right back to where we were in either 2010 or again in 2019, where the Fed is trying to convince everybody that they're going to tighten. And you got these banks out there saying they're going to hike 4 or 5 times or they're going to run off. I saw Goldman yesterday say over the weekend saying they're going to run off the balance sheet by $100 billion a month.
Wow.
Come on, man. Wow. But look, they played this game before, Andy. You go back to 2009, QE1 was going to be a one-off, right? It was $700 billion. Oh, we're not monetizing the debt, Bernanke said, and it's only a one-time deal. And so as we go into 2010, they're still trying to convince the markets of that. Well, by November of 2010, here comes QE2. And it was when the curtain was pulled back and everybody went, wait a second, they're just BSing us. That silver went from 18 to 48 and gold went from 1,000 to nearly 2,000. Okay, so then, hey, let's play this game again. So from about 13 to 18, we get Operation Twist and all this other crapola. And they let rates go up to where the 10-year note got over 3%. They ran off like $700 billion off their balance sheet in 5 years, not in 5 months like Goldman Sachs says they're going to do. Anyway, we got to that point, and in November and early December of 18, the stock market cracked. And it fell about 20% in 20 days. And the Powell pivoted in the market, and he panicked. And after a New Year's Eve meeting of the president's working group on financial markets, the plunge protection team, this really did happen. It was reported by CNN and, on regular news outlets. All of a sudden, the markets go up 1,000 points on the day after Christmas. But that was when Powell informally changed policy. He formally changed policy and started cutting rates in June of 19. Again, 19 being a year that began with all these banks talking about 4 more rate hikes and the 10-year going to 5% and all this stuff. Wrong. And again, what happened? The curtain gets pulled back. The Fed's revealed to be a bunch of charlatans and liars. Gold goes from, $1,250 to all the way to $2,100, I guess. By the time we got, we peaked out in August of last year. Silver went from 14 to 29. So here we are again. Same old crapola. Fed's going to hike rates. They're going to run down the balance sheet and all this stuff. And already we're seeing what the stock market down 10%. Okay, look, it's not going to happen. That's the first thing. Second thing is, and this is something that I picked up from Zero Hedge that I don't, they write about it, but I never see report anywhere. And it's something called the Chinese credit impulse. And that's kind of, let's just, for the sake of simplicity, it's a measure of whether the Chinese are tightening or easing monetary policy. And if the credit impulse is rising, that means they're easing. And if they're easing, then there's more yuan floating around. And invariably it flows out and they start buying stuff. Okay? So the last 4 times that they've been easing and the credit impulse has been rising, commodities have soared. And a lot of times it's spilled over into gold. Gold goes 20, 30% during that easing cycle. Silver might go twice that, 70, 80%. Well, guess what? Before we really started taking off last week, what happened? China cut one of their interest rates. And that credit impulse started to turn higher again from the same level that it's turned higher before on a chart. So I think we're in a spot now where even with the rising dollar, as we saw last week, commodities are just soaring. And I mean, not just gold and silver, they're along for the ride. Copper, the industrial metals, crude oil is $85 a barrel, wheat, soybeans, I mean, you name it. Everything's going up, and I think that's kind of tied to the Chinese buying as well. Anyway, I wrote all about that in my forecast this year that allowed me to kind of put pieces together that I expect, higher prices and some building momentum. Again, with the caveat that, I mean, God knows how this will all play out. It's going to be a crazy year.
And it's interesting because we've got Fed tomorrow. We're recording this on Tuesday. Hey, I mean, if we see a stock market where technically S&P's pretty close to being in a technical correction here. Nasdaq's already a technical correction. I mean, do you think this is? I mean, this hawkish view that it's baked in. Gold and silver have baked in these rate hikes. Now, do you think there might be some sort of pivot the other way?
Yeah.
Yeah.
Well, see, that's just it. I still see stuff. Even just yesterday, I saw some Bloomberg opinion piece about how the Fed is going to, they don't care about the stock market anymore. They want to burst the bubble. And I'm like, what planet do you live on? I mean, by artificially deflating interest rates down to zero, they have forced, not just you and me and, savers and stuff. I mean, they forced every institution on the planet, endowments, foundations, insurance funds, pension funds. Everybody's had to take on risk, whether it's high yield debt, or, some form of equities or real estate investment. You got all these big companies like BlackRock that now have these big real estate investment trusts that are buying up homes, and becoming slumlords, basically. The Fed cannot afford to wipe all that out because it would be this massive deflationary event. And for example, the pension system in the U.S. is already vastly underfunded. Mainly on the public side. There's not a lot of private pensions left, but they're vastly underfunded. And they've had to take on all this extra risk just to try to keep up. And now you're telling me the Fed is deliberately going to burst all that and wipe it all out? There's just no way. There's no way. So their credibility's at stake. Okay, credibility versus a total wipeout. I think they'll choose the side of trying to avoid the total wipeout for as long as possible. That's why they pivoted in 2019. That's why they pivoted in 2010-11. And that's why they will do so again. They took 5 years from 13 to 18 trying to play this charade out of, oh, yes, we're going back to normal balance sheet and all that stuff. They won't even get 5 months this time, Andy. They're going to be revealed for being liars. And then again, just like in the past, as the market globally figures out, wait a second, they've just been pulling our leg, that's when the precious metals seem to take off.